Hi class, and welcome to this video on Year 12 VCE Economics in Unit 3 Outcome 3. And this video is all about the concept of terms of trade. What do I hope that you get out of this video? I hope that you understand what terms of trade is, so the meaning of it, why it's important, and the factors that may influence it. So what is terms of trade? Terms of trade is simplistically a ratio, a consideration of the average prices that we've received for our exports compared to the relative average prices paid for our imports. So it's simplistically just going, how much have my prices of my exports gone up or down? And has that increase or decrease been bigger or smaller than the average price paid to our imports? Now, the comparison of this is quite meaningless until we start to put an index there. And this is what the terms of trade does. It allows us to compare this relative price levels to previous periods. So if I say that the terms of trade has increased, this means that the average price received for exports has increased more relative to the payments for imports. So this means that importantly, the nation can buy more imports from the sale of a given quantity of exports, which would be considered favorable. So it's not looking at the amount, it's just looking at price levels. So don't go get confused by that. This is not an analysis of the quantity. This is purely an understanding of price levels. And can we now buy more if terms of trade increases? This means that we can buy more imports from the sale of a given quantity of exports because the price of exports has gone up relative to the price of imports. Now, if terms of trade has gone down, it is decreased. This means the average price received for exports has decreased relative to the payment of imports, and this means the nation can buy less imports from the sale of a given quantity of exports, and this is considered unfavorable because remember, material living standards, all those sorts of things is all about how much can we buy in terms of our purchasing power. So what has been happening to our terms of trade? If you are really interested, here we have our formula, and you can see here, this is our formula. We consider the export price index and our import price index and times it by 100. You can see that generally this has really been increasing, and that we would say that there has been a couple of booms where it has really peaked. And we know that a boom means it will go down for a little bit. It has gone down up in 2015, and it has been steadily rising since. Why have we had an overall general upward trend? This is largely due to the high growth rates in China and India and their demand for raw materials. We provide a lot of more materials in terms of iron ore, gas, all those sorts of things, and these have increased in price because of the high demand in China and India. In addition, a lot of the imported goods that we have been importing have reduced in price or relatively reduced in price due to technology and global competition. So there has been this overall increase. Why from 2011, and you can see this is post the boom, have we had a bit of a decrease up until about 2016? This was a period of low international growth, and hence the demand for all of our goods that we try to export were quite subdued. So what are the factors that impact it? It all comes down to supply and demand, because supply and demand determines our equilibrium price. And we are thinking about what are the supply and demand factors that are going to impact our imports and exports. Because if there is factors that are going to increase the price of our exports, more than the price of imports, this is going to result in a positive terms of trade. So we're coming back to this concept of supply and demand and how this is going to create new equilibrium prices, and is it going to create in a lower or high equilibrium price. So for example, what could be a global condition in demand that is going to impact exports? When there is a decrease in the global demand for Australian exports, this is going to result in a decrease in demand. And this will result in us going from D1 to D0. Now, if you see that, then you can notice that the price of our exports has gone down, and this will result in a terms of trade decrease. What could result in this? For example, weaker economic growth in our major trading partners like China and Japan, and we saw that in our terms of trade going down in that time. Maybe depressed consumer confidence or business confidence, resulting in them overseas entities not wanting to expand and not wanting our exports, or potentially reduced growth rates in global income or population. These will all result in a decrease in our exports. Now, there could be an increase in the demand for our exports for a number of reasons as well. And this would result in us going from D1 to T2, leading to a new equilibrium price, E1 to E2, leading to an increase in price from P1 to P2. Now, what could be some reasons for this? Strong economic activity in our trading partners who demand our exports, improved consumer and business confidence, and maybe increased growth rates. And we saw that significant terms of trade increase was largely due to this growth in economic activity in China and India. So really this factor here. Global supply is really important as well. When there is an increase in the global supply of exports that we are trying to do, this often will reduce the price. So if we have for example, a increase in supply, we're going from S1 to S2, this will result in our equilibrium price going down from P1 to P2. What could result in an increase in supply that's going to impact our exports? There might be, for example, new discovery of resources, new technology or productivity that increases production, or really good climatic conditions. Now, this might be seen as a good thing if it's just happening in Australia, because this will increase our supply. But if it's happening overseas, that will often result in or overall in the market, a decrease in the price. When there's a decrease in global supply, that Australian goods export, this will often result in an increase in our equilibrium. So there is lots of things to consider, but we're always coming back to the fundamental fact: what is impacting the export prices? What is impacting the import prices? And those prices are always impacted by supply and demand. So now we've got a good understanding of terms of trade and how it's the relative price of exports to imports. And there's lots of factors that impact it. What is the impact of terms of trade on important economic metrics, namely our current account balance, domestic macroeconomic goals being strong growth, because we know that we want strong growth that isn't going to result in inflationary pressures, low inflation, so roughly between 2 to 3% inflation, and full employment, where there is no cyclical unemployment and just structural unemployment, so roughly around 4 to 5% unemployment. And also living standards. So how does terms of trade impact living standards? If terms of trade increases, this means the average price received for exports increased relative to the payment of imports. This is seen as favorable and will improve our living standards. The nation can now buy more imports from the sale of a given quantity of exports. This is favorable. We now have an increase in our purchasing power and hence an increase in living standards. Now, this is really important because we do a lot of exports, and we do a lot of exports of commodities that fluctuate in their price. So we need to be thinking about what is the price of our exports of those commodities, because they're a significant part of our exports, and any price rise will positively impact terms of trade and living standards, and a decrease will decrease our terms of trade and living standards. Now, we also need to be understanding that terms of trade might have increased not because of an increase in our price of our exports, but because of a relatively decreased price in our imports. And the price of all these manufactured goods that we import, if they're going down, this will impact our terms of trade and improve our living standards because we're getting the goods and services that we want cheaper. We have more ability to purchase more of them. Now, conversely, if terms of trade decreases, this means the average price we see for our exports decrease relative to the payment of imports. And this means we can buy less imports with the same quantity of exports, and we're going to have a decrease in our purchasing power. So a decrease in our purchasing power, and this will decrease our material living standards. So it's a quite clear link between terms of trade and material living standards. How does terms of trade impact economic growth and full employment? Given we grow national income from a higher terms of trade because we have higher export prices compared to import prices, you would expect a higher terms of trade is favorable and will improve, as we could say, these important goals of strong economic growth and employment. A rise in terms of trade will increase our export income. This flows through to our aggregate demand and GDP and will increase our economic growth. This can lead to increased demand for labour and hence place downward pressure on the unemployment rate. So it's seen as a good thing. And this rise in terms of trade will lead to companies having higher profits, which might lead them to invest more, and wages and dividends and expand. And this will further boost aggregate demand, consumption, investment, and exports components, leading to more growth and more material living standard improvements. So you can see the power of terms of trade. Conversely, a decline in the terms of trade will often reduce our ability to meet these goals of strong growth and full employment because we have weakened the value of our exports relative to imports, and hence in itself tends to slow aggregate demand, but it also will then have a spiral effect. Now, if terms of trade growth is driven by lower import prices, this can also help lower production costs. So there is a lot of things going on here, and you're going to have to think this through if you receive a question. And here is a chart which I'm going to get you to do some analysis of yourself. Can you start to see some links between these? And it's often hard because there's a lot of noise in these charts because so many other factors impacting it. But here we have a chart measuring economic growth, employment, and terms of trade. And theoretically, as terms of trade increases, we should start to see more growth, so higher real GDP growth, and lower unemployment. Probably not coming across fully in this chart, but because there's so many other factors flowing around. Now, how does terms of trade impact inflation? We have a goal of price stability of maximum 2 to 3% inflation, which means that we're going to have a sustainable economy. A higher terms of trade can reduce inflationary pressures if driven by a fall in the price of our imports. So remember, higher terms of trade might not be because we've had increased price in our exports. This might have increased because relative to the price of exports, we've had a price drop in terms of our imports. This is a driver of inflation. So in higher terms of trade could reduce inflation if driven by a fall in the world price of our imports. Australian importers experience lower prices, lower production costs, which lowers supply side or cost inflation. However, if our terms of trade has increased due to rising world price of our exports, this could result in inflation because we're going to have a heated up market with aggregate demand going higher. So you can see actually terms of trade being high could have a positive impact on inflation or a lower impact, depending if it's going to impact demand inflation or cost inflation. And here you can see a chart to do some analysis there, and it's a little bit hard again to work through it. How is it terms of trade going to impact our current account deficit, or perhaps more accurately, our current account? And our current account is all about the inflows of cash or income or money from foreign entities minus all the outflows. And if we have more outflows than inflows, we have a current account deficit, which is what we've historically had in Australia. Although we do know, if you've been following my videos, currently we are in a current account surplus where our outflows are more than our inflows. A fall in terms of trade tends to cause us to have a higher current account deficit, a deterioration in many views. This is because when we receive lower prices, for example, from our exports compared to imports, this means that there is a relatively weaker demand internationally for our exports in terms of value of our credits, so our exports decreases, meaning we're going to have less value from our exports than imports, leading to a current account deficit, for example. A rise tends to cause the current account deficit to fall or improve because we're getting more funds from our exports relative to our imports. Don't forget though that terms of trade is just about price, so quantity is also a factor here. How does it impact exchange rates? A fall in our terms of trade tends to weaken the Australia's exchange rate. This is because lower export prices indicates that we're getting less demand for our exports. A rise in our terms of trade will often push up the value in our Australian dollar because people need to demand more Australian dollars to get our exports, which are increasing in price. Now, guys, I hope that you found this video useful. It explains terms of trade, the impact on our goals, and what a term of trade increase or decrease will impact those things. I hope you found this video useful and that you continue studying Year 12 economics.